All right, let's dive right in. Welcome to This Explainer. Today, we're settling what is basically the ultimate financial heavyweight fight of our time. It's the battle of the asset classes, tangible, physical real estate, up against the invisible, mathematical stock market. Now, you know the drill. People love to argue about which one actually builds more wealth over the long haul. You hear it at barbecues, you see it in the comments sections, but today, we're not doing opinions. We're running the actual math, step by step, over 2 full decades to show you exactly what's happening behind the scenes.
So think about this. If you take $50,000 and put it into property, and another $50,000 and just drop it into stocks, who is the richer investor 20 years from now? The answer to this is absolutely going to change how you view your own portfolio. Honestly, it'll probably challenge everything you think you know about passive income, compound interest, and the true cost of managing your money.
To keep things totally fair here, we're going to follow 2 investors, Jake and Marcus. They're the exact same age, they live in the exact same city, and they both make the exact same salary of $55,000 a year. Their financial starting point is literally identical. The one and only difference in their lives is what they decide to do with their 50 grand.
Now, right on day one, there's this massive psychological contrast. Jake takes his 50 grand and uses it as a 20% down payment on a $250,000 rental property. He takes out a mortgage at 7%, finds a tenant, and boom, he's got a house, he's got keys, and he's got an amazing story to tell at dinner parties, right? He feels like an absolute genius. Marcus, on the other hand, he drops his 50 grand into a total stock market index fund. No leverage, no tenants, he just sets up an automatic contribution of $300 a month and completely ignores it. He basically gets a boring brokerage account and a confirmation email. Nobody at the dinner party cares about that. So Jake feels like he is crushing the social proof game, while Marcus just has some numbers on a screen. But as we'll see, feelings and math are 2 very different things.
Okay, we're going to track Jake and Marcus over a chronological timeline. Year 1, Year 3, Year 5, Year 10, and finally Year 20, to really see how time reveals the hidden costs of both strategies.
Let's start with years 1 to 5, the landlord reality check. Checking in on Jake, at first, he is living the dream. He's driving past his property, collecting those rent checks, deducting depreciation on his taxes, his tenant pays $1,800 a month, his mortgage is roughly $1,330. So, on paper, that's $470 of pure monthly profit before he spends a dime. But, you know, the illusion of passive income is about to hit a massive wall called property management.
By year 3, Jake's collected a really fantastic-looking number, $16,920. This is his gross cash flow. It's the exact napkin math everyone loves to brag about on those YouTube thumbnails, right? But what nobody brings up is everything that comes right out of that rent check before you actually get to keep a single dollar of it.
Yeah, that rent check gets instantly devoured by hidden costs. You've got property taxes, insurance, general maintenance, major capital expenditures like roofs and furnaces, and vacancies. If you aren't setting aside money every single month for these guaranteed future expenses, you're not really running a business. You're kind of just running on luck. And for Jake, well, that luck ran out fast. In just 3 years, his taxes were $3,000 annually, insurance was $1,500, then boom, $1,200 to replace a water heater, $2,800 to fix a leaking roof. On top of all that, he had a 1-month vacancy between tenants, which cost him another $2,400 in lost rent and cleaning fees. Oh, and property management? Jake's doing it himself to save that 8 to 10% fee, which means he's the guy taking 10 p.m. phone calls, doing weekend showings, coordinating repairs on his lunch break. Basically, he turned his investment into an unpaid, highly stressful part-time job.
So after all those completely unavoidable expenses, Jake's actual net cash flow over those 3 years isn't 16 grand. Actually, scratch that. It's a stomach-dropping $2,000 to $4,000 total. His cash-on-cash return, the actual profit he's seeing on his initial 50 grand, is hovering around just 3 to 5%, which, hey, isn't terrible, but it's definitely not the 15 to 20% return he was bragging about. And remember, that doesn't account for a single hour of his time.
But before we count Jake out entirely, we have to talk about his superpower, leverage. Now, leverage just means using borrowed capital to control a massive asset with a tiny bit of your own money. Despite the miserable cash flow, Jake is building serious wealth under the surface. He used 50 grand of his own cash to control a $250,000 asset. The bank paid for the rest, but Jake gets all the appreciation on the full $250,000 value. The property goes up 3 to 4% a year, and the tenant is slowly paying down his mortgage. This right here is the one huge advantage stock investors can't easily copy.
All right, let's jump to years 7 to 10, the compounding curve.
Let's check back in on Marcus. Remember him? He's been doing absolutely nothing. 0 hours, 0 phone calls, 0 emergencies, just auto-investing his $300 a month. But right around year 7, his boring index fund strategy hits that sweet acceleration phase of compound growth. The gains on his gains are now generating more new wealth every year than his actual original contributions.
So by year 10, they are surprisingly close. Jake's equity, thanks to that leverage and his tenant paying the mortgage, is sitting somewhere between $170,000 and $184,000. Marcus's portfolio is right behind him at roughly $165,000 to $180,000. But here's the massive catch. To get that slight edge, Jake spent tens of thousands in out-of-pocket maintenance costs and literally hundreds of hours of his own time. Marcus, he spent 0 hours and never lost a single night of sleep.
Which finally brings us to year 20, the final tally. 2 decades of holding and investing, leading to the ultimate results of these 2 totally different strategies.
Let's look at these final metrics. After 20 years, Jake's property is worth around $500,000. His mortgage is nearly paid off, leaving him with $400,000 to $500,000 in equity. And Marcus? His original $50,000 plus his steady $300 a month has compounded into $420,000 to $460,000. Guys, they reached the exact same financial destination, but they paid for it with totally different currencies. Jake paid with high debt, hundreds of hours of labor, and massive stress from tenants and broken pipes. Marcus paid with 0 debt, 0 time, and just had to endure some market volatility while sleeping peacefully.
And what about scaling? If Marcus wants to accelerate his wealth, he literally just logs in and bumps his monthly contribution by $200. That tiny change multiplies through compounding, and his 20-year portfolio jumps up to nearly $600,000. Takes him, what, 30 seconds? If Jake wants to scale his real estate wealth, man, he's got to save up another massive down payment, take on another 30-year mortgage, find a new property, screen new tenants, and quite literally double his workload.
So, we need to talk about the hidden nuances, leverage versus volatility. Because to be completely fair, we can't just dunk on being a landlord. We have to look at the nuances of both paths. If we only looked at Jake's downsides, we'd be doing exactly what every finance influencer does, ignoring the brutal reality of stocks and the unique superpowers of real estate. Let's be real about Marcus for a second. Yes, no tenants, but he had to stomach brutal volatility. In 2008, the market dropped roughly 37%. March 2020, down 34% in a single month. Imagine watching your $150,000 turn into $95,000 in a few weeks. That is gut-wrenching. And data shows most retail investors panic sell during those crashes, locking in their losses at the absolute worst possible time. Plus, stocks offer 0 leverage. His $50,000 only controls $50,000. And there's basically no usable cash flow. A tiny 2% dividend yield isn't replacing anyone's day job.
On the flip side, real estate creates more millionaires for a reason. Jake has that 5-to-1 leverage advantage. He's got the absolute magic of depreciation, which is a legal tax shelter that shields his income, even while his property goes up in value. If he wants to sell, he can use a 1031 exchange to roll his profits into a much bigger building, completely tax-free. Or he could have just house-hacked, living in one unit and renting out the others to drop his living expenses to basically 0. Stocks just can't do this. Real estate wins, for sure, but it wins in very specific, highly managed, business-minded situations.
This brings us to the real investment trap. Both Jake and Marcus walked away on day 1 totally convinced they made the smartest, most bulletproof choice. Jake thought real estate was the guaranteed path to wealth. Marcus thought the market would just magically do all the work. But neither of them mapped out the true cost over 20 years.
The biggest takeaway from this explainer is this. The real trap is picking either one based on a headline without ever running the full numbers for your own situation. The danger isn't real estate, and it isn't index funds. They both work. The real danger is blindly following some podcast clip or your uncle at Thanksgiving without calculating your own personal threshold for debt, stress, risk, and time.
Which leaves us with this final thought. Next time someone guarantees you that real estate always wins or that the stock market always wins, challenge them. Ask them this one simple question. Did you include everything? Because an answer that doesn't account for your time, your taxes, your sleep, and the hidden costs of scaling, well, it isn't really an answer at all. Thanks for joining me on this deep dive. Now go run your own numbers, and I'll catch you in the next explainer.